The topic for today's video is reviewing different assumptions in a whole life insurance policy. When I say reviewing different assumptions, what I am referring to is reviewing different crediting rates. So if you're interested in a whole life insurance policy, cash value is the primary goal, or you're interested in maximizing it, it's very beneficial to look at different crediting rates. For example, with a whole life insurance policy, you will often see a dividend rate with the insurance company you are selecting. We're going to look at an example of a Guardian policy today. Guardian's 2023 dividend interest rate is 5.75%. So that will be the current assumption, or the current dividend rate, when we look at the illustrations. I should say one of the assumptions. But then what we'll also look at are the guaranteed assumptions, meaning in a worst case scenario, if dividends are never paid and we look at the maximum charges assessed to a policy, what do the guaranteed values look like? And then if we look at a best case scenario, what we can do is actually tie the cash value to the S&P 500 index, which does grant greater earnings potential on our cash value and long-term death benefit for that matter as well. So when reviewing different assumptions, it's very beneficial to see everything up front, particularly the guarantees or more conservative scenarios. Because where people often get upset is when they take out a life insurance policy, they see the long-term cash value growth, and then as they track the actual performance over time, they see that what was illustrated has not come true, and they have significantly less in value. That's often where people have buyer's remorse because they feel like they were told they would have a lot of money and then they don't, which we never want that situation. So looking at conservative scenarios, whether it's a reduced dividend or guaranteed values, allows you to see lower values up front and really helps you to determine, am I still comfortable with this? Reviewing the actual performance of a policy, meaning have they actually delivered over time, what's their track record, is important. And I'm not referring just to dividend history when I say that. I mean real whole life insurance policies that have actually lived the test of time. And we have proof of performance from your four major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. So as we review the different assumptions today, we're going to use a case study that's based on a 40-year-old individual. He's got money in cash that he would like to move into a whole life insurance policy. This is a very common case study that we work with. Individuals that have a lump sum of cash, in this case, $500,000, that he wants to move into a whole life insurance policy. So what we're going to look at in this particular scenario is $100,000 per year for 5 years. That's how he wants to shift money from his checking and savings account to a whole life insurance policy. After that, an emphasis on no more payments. When starting the policy, he does not want to have to pay anything into the product after that $500,000 is paid into the policy. Now, the policy will be equipped to handle additional payments after year 5, but at the same time, we're setting it up where he can easily stop altogether after 5 years and even earlier in the event that life happens. But very important to him right here, and this is important to a lot of people, particularly when working with lump sum scenarios. Now, the cash value is what he is interested in. So we've got the core benefits to the cash value in a whole life insurance policy being a safe, liquid, and tax-free area to position money. Tax-free if we do not trigger a taxable event, which I would check out this video, which provides full details on what can trigger a taxable event with a whole life insurance product. So the different assumptions that we are going to review, we've got the guaranteed values, dividend values based on the company's present dividend interest rate, and then also the indexed rider values, which is based on the past 20 years of the S&P 500 performance. What we can do with this policy is elect to tie our cash value to that indexed rider, which does grant greater earning potential. The fun part about it is we can actually switch back and forth between that and the dividend over the years. We can even elect to put a portion of our cash value into the basic dividend portfolio, meaning receiving the basic dividend rate, and then a portion of our cash value can be tied to the indexed rider. So it's a nice option that we can be creative with over time, and we don't have to pick one option and then we're locked in for life. There are some other things we want to be aware of with this rider too, as there is a fee that's assessed when we exercise it, and we do have a couple of videos on our channel that provides a full breakdown on exactly what the fees are, how the rider works. We often like to attach it to policies at 0% because there's no fees if we never use it, but it gives us the opportunity to use it in the future if we decide that we'd like to do that. So with the assumptions, what we're going to look at here is a couple bullet point items that a lot of people like to look at, or just over the years in working with individuals, we've heard them express, hey, this is very, very helpful just in seeing what the total growth on my life insurance policy is. What we're going to look at with respect to the growth is how to measure it. We'll look at both dollars and rate. So when we look at the dollars, what we'll look at is the yearly growth. Specifically, what is the cash value growing by year over year? And the net dollar amount, meaning all I want to know is what am I receiving from the insurance company. What I don't like to do when measuring the yearly growth on a life insurance policy is account for my own payments. For example, if I have 0 in cash value, let's say I'm starting day 0, I pay $10,000 into a policy. At the end of the first year, my cash value is $8,500. Some life insurance companies will disclose reports that will show the yearly cash value growth is $8,500 because day 0, you're at 0, and then after 1 year, you're at $8,500. I'm not a big fan of that. The reason why is because you've paid in $10,000, and if you have $8,500, that's an effective $1,500 loss. So I want to know simply, what did I receive in total growth from the insurance company? And we can look at both the dollars and the rate, and we'll look at the internal rate of return for that. So back to dollars, we'll look at the yearly growth and then the total gain on the policy over time. And then for the rate, we'll look at the annualized internal rate of return and also the average internal rate of return, which allows you to see the net growth rate on a policy. Because if we're looking at the dividend rate or even the guaranteed rate for that matter, that can be confusing because you'll never see whatever the dividend rate is. You won't see that rate translate to the actual growth rate in your policy. Let's look at exactly what I mean when I say that, and we'll have some fun with this. So what we'll look at first are the guarantees. So we'll look at the yearly growth first. Guaranteed values. Here we've got a product on a 40-year-old individual funding $100,000 per year, and this policy is designed as a 10/90 split, a little bit lower than a 10% base premium. It's a little over 9%, but with a term rider and such, just about a 10/90 split, meaning 10% base premium, 90% PUAs, in order to really accelerate the cash value growth. This person is interested in maximizing their cash value. So looking at the year-to-year growth, he pays in $100K. Here's his total payments in the first year. He's paid in a total of $100,000, and his cash value is what? $88,373. The death benefit is just over $2 million. Where we came up with that dollar figure is that it gives him a MEC limit of $100K. That prevents a taxable event from occurring. But when we look at the yearly growth, so let's look at the far right first. Annual CV growth. CV represents cash value. It's negative $11,627. The reason why is because you paid in $100,000, you have $88,000 in cash value, which is a loss of $11,000 in change for that year. Now the next year, or actually before we go to the next year, if we look at the rate, our IRR, which represents internal rate of return, same thing, negative 11.63%. Let's look at the next year. He pays in $100,000. His cash value, year 1 was $88,373. Now it's $186,604. What I'd like to say here is if you had $88,000 in change under your mattress, earning 0% because it's under your mattress, and you added $100,000 to it, what would it be worth? $188 and change. However, here, it's worth $186 and change. So we have less than the $100,000 payment we made, which results in a negative internal rate of return. We lost a little bit less than 1%, and there it is in dollars. We took a hit of just about $1,800. The same is true in year 3. But then after that, and this is based on the guarantees, so this is an absolute worst case scenario in this example. The break-even point, almost year 6 in this particular case. And there's the yearly cash value growth, what it's growing by each year. And there it is translated to an internal rate of return. And keep in mind that this is an annual internal rate of return. So if you were to ask the question, what did the policy grow by this year or last year, this rate would tell us that. The average internal rate of return is a bit different, which we'll look at next. Here's the exact same thing, but based on averages. So as we look at the cash value and death benefit column, they are identical because it's the exact same policy. The only difference here, average internal rate of return instead of annual, and then the total gain. So here, what do you notice? Well, in the last example, again, based on the guarantees, when were we positive as far as the yearly cash value growth? Year 4 was the first year. Here, we're still in the red. And you'll notice that you're in the red until we hit the area that's highlighted in yellow. And the reason why is because when we hit yellow, or when we hit the highlighted section, that represents our break-even point. When our cash value exceeds our total payments. So he's paid in a total of $500,000 over 5 years. By year 7, he's got 507 and change, which represents an average internal rate of return of 0.31%, which comes out to a $7,800 total gain. And then over time, here we go. Let's look at year 20. 500 in, 700 in cash value. Death benefits at 1.3. But there's your average IRR, 1.91%. And that comes out to a total gain of $200,000. And a cash value life insurance policy based on an absolute worst case scenario because we've got the guaranteed rate and we're also assuming the maximum allowable charges are assessed to the product, mainly on the term insurance rider. That's the only rider other than the PUA rider in this policy. So let's take a look now at scenarios that are not the worst case scenario. So what we'll look at first, let's go back to the yearly growth example. We've got the present dividend rate right now. And Guardian's a company over the years, as we've tracked the actual performance, I've seen them deliver in many cases spot on with what was illustrated, meaning if they illustrate $300,000 next year on their illustration, and then we look at the annual statement and the actual value over the course of the year, it hits exactly that $300,000, assuming the dividend rate has not changed, and it also assumes we've made payments all up front. But my point is, we've seen them deliver along with all of the major mutual companies as we've studied them. So let's take a look here. We've got the present dividend interest rate. Now, first year, what you'll always notice, the dividend cash values and death benefit figures will be identical with the guaranteed values because dividends are not paid in the first year. However, the second year, look at this. You pay in $100K. It was 88 and change. Now it's worth 190 and change. So what this means is you got your $100,000 back in year 2, plus a little bit more. Here's the exact dollar amount, 2403, which comes out to an annual internal rate of return of 1.28%. Break-even point is in year 4 in this particular case. And there's the IRR over time. And there's the annual cash value growth. And this is based on Guardian's L95 product with their 5% PUA fee, which will have stronger guaranteed values. But on the non-guaranteed side, this IRR and cash value growth is a little bit weaker than what you would see with the 10% PUA fee. And we've got videos that provide a side-by-side comparison and explanation of fees. But this is a nice option here as we see it continue to appreciate over time. He's got no payments after year 5. Specifically, what we were doing in this case is we've got a premium offset in years 6 and 7, meaning the policy is paying for itself through dividends and interest. And then you'll see the death benefit drop in year 8. The reason why is because we executed a term rider reduction and also reduced paid up. All that does is eliminate the premium altogether. If we exercise that option, we can't make any more payments, even if we wanted to, which is what we illustrated here. However, at that point in time, we'd actually have to make that choice and sign paperwork if the client wants to do that. But here's the annualized IRR and cash value growth. Let's look at the same thing based on averages. Here we go. There's your break even year 4. Why I highlighted that. You're in the red up until that point. Total gain, for example, year 3, negative 4116. The reason why that's the case, look at the annual outlay, 3 years of 100K. Total payments, 300,000. Cash value, 295,884. If you subtract those two, you get this figure. So that's the loss right there. So if we were to cash the policy out in year 3, which I would not recommend, but if we did, that's what we would walk away with, assuming over the first 3 years, the dividend rate did not change and we hit that exact value. Actual values will be different from illustrated values, which if you work with us, you know that as we track the performance over time. But same thing with the total gain. So if we look at year 20, at the guarantees, what was it? 200,000. Over here, more than double that, 464. Let's look at one more assumption, the indexed rider, which will look a lot better, but it is hypothetical. So this is perfectly fine to look at, but full disclosure, it's based on market history and things will change over time. Again, I like attaching this rider, but if we attach it, I like to add it at 0% and then flip it on in the future if we want to. A few people we work with do just set it at 100% forever. Some go 50%, meaning 50% of the cash value is tied to the S&P and the other 50% is tied to the dividend. So you can be creative there. But what you'll notice is firstly, the first 3 years, it's identical to the dividend, because if we have a term rider attached in which the death benefits level initially, the indexed rider cannot be assessed until year 4, cannot be activated or go into full effect until year 4. But then you see that impact in year 4 as we've got a cash value difference, about $2,000. If we look at the growth here, let's just go to year 20. What do you notice? IRR is strong. So is the yearly cash value growth. But again, hypothetical. And then if we look at the total gains, there we go. Same thing here. There's your year 20 value. Looking at that. Pretty cool how it continues to jump up. But again, we're going to track this over time. These different columns, the average IRR, the total gain, or the annual cash value growth, we can show them all, like we can put them in a report along with the full illustration for anyone we're working with. But if you are working with us and you prefer one over the other, usually we'll still include them all in a supplementary piece, but on the main cover page, we'll put the item that you're most interested in. If you request it, if you said, hey, can I see the yearly cash value growth? Because that's what I'm most interested in, so I can see what it's growing by each year. And then if I plan on using the money, I can compare what the policy is growing by each year directly with what I am paying in loan interest, for example. So I can see if I'm positive or negative. A lot of people like to do that. So with the assumptions, I do like looking at those different examples there. Last thing I want to hit on are some of the drawbacks, because this is important to hit on. What are the drawbacks to whole life insurance, particularly when someone is interested in maximum cash value? Well, here they are, the main items that pop up. Number one, the first year is the worst year because I will have that hit. If we go back to the example we just looked at, that was a policy set up for maximum cash value. We had the premium minimized. He paid in $100,000. What was his cash value? It's $88,000 and change. So he has the majority of what he paid into the product available at the end of the first year, but it's not his full $100,000. That's an $11,000 and change hit on his money. That is a drawback, regardless of the dollar amount you're looking at. If it's $10,000, $100,000, $500,000, having transparency and actually someone bringing that up to you to say this is the hit, it can be a reason why people don't do this. First year's the worst year for full transparency. Next, 3 to 5 years to get your $500K back. So his goal was to move $100,000 per year into the policy for 5 years, that excess money in cash, and he did that. When was the break-even point? The guarantees were just about year 6. Year 7, he was positive. Based on the dividend rate and also that indexed rider assumption, year 4, he was positive. And we've seen that be the case with Guardian policies as the policies we've written, as they've lived the test of time. When people have max funded, a lot of times we see them fall between years 3 and 4, particularly with that 5% PUA fee. But that takes a few years to get our money back. Some view that as a drawback. And then the last item here, compare the growth with the loan interest. So if someone is planning on actively using their policy, perhaps for real estate opportunities or whatever it might be, if they're going to take a loan against their life insurance policy, they want to know what that cost to borrow is. Not just the interest rate, because I can say the loan interest rate with this product is 5%, because that's what it is. It's a fixed 5% loan interest rate, with a couple other items to be aware of that I would check out in our All About Guardian video. But when we look at that loan interest, the rate's great. However, what's the actual dollar amount that I have to pay, and then allow me to compare that with the growth rate to simply see, am I paying more in loan interest than what the insurance company is crediting me in interest? And in the early years, I'm going to be upside down because I have a negative hit in my money. So what we'll look at, we can look at it on an illustration when we run actual loans. We can also look at something like this, which allows us just to duplicate it real quick. So we've got the policy based on the dividend assumptions, not the indexed rider or guarantees, the dividend rate assumption. 100K per year for 5 years. There's your total payments. There's that break-even point. And then we've got the annual internal rate of return and the yearly cash value growth, along with the total gain on cash value. So the IRR allows someone to see what is the annual growth rate directly compared with the interest rate. And if we wanted this to look positive, we could plug in the indexed illustration, but then we're looking at hypotheticals and setting ourselves up for a situation where, hey, I'm going to be positive. And then if the product does not perform or the market doesn't perform, it might not pan out. I don't really like doing that at all. But some people will like to plug in the indexed values just to see a what-if scenario. That's fine, as long as we're looking at things conservatively too. But here, we've got the rates side by side. But these two are really what I like to look at. The yearly cash value growth and the total gain. So here, LTV, loan to value, 95% of the cash value. So whatever your cash value column reads, this will be 95% of that. Let's assume you want to take a loan. Let's say it is for $250,000 in policy year 3. So what we'll do is plug in $250,000. There we go. And let's assume no payments first, because I want to show you what I'll look at here. Here's a $250,000 loan at 5%. What does that come out to? $12,500. We've got annual interest payment. This workbook will always assume that you're paying the loan interest out of pocket. It is optional with direct policy loans, which we would want to look at a scenario like that specifically. What does a policy look like if we pay interest, don't pay any interest or any principal, and then pay it back in full? This example will just show paying interest and then paying it in full. But we've got the annual interest payment, which shows if this is you, how much you're paying each year in loan interest, $12,500. And what it allows you to do is now, okay, if I take out $250,000 in year 3, when my gains were $5,100, but I paid $12,500 in loan interest, I'm in the red. I'm paying more in loan interest than what the policy is earning. However, next year gets close, and then by year 5, the gains are $14,400, where I've paid, again, $12,500. And how that works, because the earning rate is 285, whereas the loan interest is 5%. The reason why is because you've got that 5% on the 250 and the 285 and the 520. So it's your full cash value there. And then also the total gain, but we'll look at that in a second when we pay it back. Let's pay it back. Let's assume that we pay interest only years 4 and 5 because you're still funding the policy, and then begin to repay it in year 6 at, we can pay it back however we want, $50,000 per year. Okay, 5 payments of $50,000 in addition to the interest payments out of pocket each year. So what I really like about this is each year you can see the loan interest and directly compare it with what the gains are. If I take more loans, which I can, all based on my available equity, then obviously I'll see the loan balance go up, and also the interest payment go up. But assuming we don't do that here, 12,500, look at this guy, total interest payments. So by the time that loan is paid, how much did you pay in loan interest? $62,500. So often what people have expressed they like to do is compare the total interest paid with the total gain on the policy. So this way I can look at the yearly growth compared to the yearly interest, and also the total growth compared to the total death benefit. The one thing this workbook does not do, which happens, is if I take a $250,000 loan, my death benefit will be collateralized. It will drop by $250,000. So it'd be 1.8 in this particular case. And again, this workbook is really meant to duplicate a collateral loan, but even with a collateral loan, if I die with a loan outstanding, the death benefit is going to pay off the lender in this case. If it's the insurance company, you'll see the net death benefit would be $1.8 million. Some of our videos that go through how loans work provide a full breakdown on that. But this is helpful for a lot of individuals just to get a quick idea of what things will look like. The numbers are not exact because the interest is based on an annual calculation. So for example, if you're making payments monthly, then you're going to chip away at the balance faster, most likely, which will result in less interest. So things like that have to be factored in as well. But again, it just lets us get a quick projection. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. If you have any questions or comments, please leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.